Artificial intelligence has been busy changing the world in quiet ways for decades. But the release of OpenAI's ChatGPT back in November 2022 quickly turned into a very noisy revolution. Almost instantly, bright and creative minds everywhere started thinking about how this new natural language processor, and others like it, could be adapted and applied to existing processes, environments, and entire industries. Some people aren't sure that all the hype over generative AI is justified, but I'm seeing some really powerful, game-changing potential. Lots of great folks are busy exploring the many possible ways that AI might be actively and intentionally applied. But I'm also interested in unintended consequences. In other words, what secondary effects might come from the mass AI adoption. So for this discussion, let's talk about the retail investment world. That is, I'm trying to get my mind around what it'll look like when millions of private investors guided by AI algorithms, as opposed to institutional investors like banks and hedge funds, all hit the discount online brokerages like Robinhood at the same time. We're already starting to see sophisticated experiments involving feeding AI tools with vast historical market analysis data and making the output available for consumers. Portfolio Pilot and Composer.trade are two fairly mature possible examples. But suppose millions of investors sign up. How will that change the market itself from a macro perspective? First of all, it's reasonable to assume that AI can potentially be applied to improve investment decision-making by providing more accurate predictions and recommendations based on large data sets and sophisticated algorithms. Of course, AI is only as good as the data it's trained on, and there are concerns about bias in the training data used to develop AI models. Additionally, there are regulatory challenges related to the use of AI in finance, including ensuring transparency and accountability in decision-making processes. In other words, it's possible that the AI-powered investment airplane may never actually take off. But moving past that relatively unlikely outcome, individual investors could come to play an increasingly significant role in shaping market trends due to their sheer numbers and growing influence. Let's talk about some of the ways that could play out. For instance, when retail investors buy or sell en masse, they can create sudden price movements, leading to increased market volatility. This was evident during the COVID-19 pandemic when retail traders fueled a surge in stock prices through online platforms like Robinhood. Large-scale changes in retail investor sentiment can lead to a shift in market sentiment, causing asset prices to rise or fall regardless of underlying fundamentals. So, for example, if retail investors become optimistic about a particular sector or company, they may drive up demand for those assets, even if there aren't necessarily strong reasons to support the increase. The rise of robo-advisors and other digital wealth management platforms can further disrupt traditional investment patterns by offering low-cost, diversified portfolios accessible to a wider range of investors. This democratization of investing could lead to new market dynamics and potentially upset established power structures within the financial industry. Well, depending on your perspective, this could either be a good thing or a bad thing. I lean towards good. With the proliferation of social media and online platforms, retail investors can now easily share ideas, form communities around specific investment themes, and pressure institutions to take notice. This emerging trend towards decentralized investing could give birth to novel market phenomena and challenge traditional forms of market analysis. As retail investment behavior volumes grow and exercise greater influence, regulators may need to adapt existing regulations or introduce new ones to address risks associated with the shift. For example, stricter requirements for reporting and disclosure from retail investors or greater oversight of online brokerages could follow. Retail investors often trade less frequently and at lower volumes compared to institutional investors. I happen to think that's a good thing. My personal investment preference involves buying lots of the Vanguard S&P 500 ETF index fund and then ignoring it for 50 years. But on a larger scale, fluctuations in retail investment activity can reduce market liquidity, making it harder for other participants to enter or exit positions quickly enough without significantly affecting prices. Retail investors tend to chase popular trends and pile into certain sectors or assets, creating bubbles along the way. These bubbles can eventually pop, leading to sharp reversals and losses for unsuspecting investors. History has shown us examples of such bubbles, such as the dot-com boom or the housing market crash. In fact, traditionally, retail investors lack proper knowledge about investing principles, resulting in poor decision-making and susceptibility to fraudsters preying upon naivety. However, adding properly designed AI to the mix should help close this education gap, leading to benefits for both investors and markets by promoting informed choices backed by solid understanding. After all, AI guides should excel at encouraging self-control and discipline. As retail investors gain more influence, there exists the possibility of systemic risk stemming from coordinated actions taken across many individuals simultaneously. Imagine millions of people all buying or shorting the same security. Such collective action could trigger flash crashes or exacerbate market instability. Similarly, social media platforms allow retail investors to engage in discussions, debate strategies, and react swiftly to news events. While this can foster healthy market competition, it also creates opportunities for feeding frenzies, rapid price swings driven largely by emotional decision-making rather than careful analysis. These situations can lead to unjustifiable gains or losses for innocent parties caught off guard. That'll sure be fun to watch. These are just a few quick thoughts on the subject. I hope to be back soon with some more technology second-order effects. But please do share your own insights.